Ready to pass the CPA exam faster? Visit cpapass.ai. Today, net book value calculation, mastering asset value and transactions. To master FAR, you must master the net book value calculation under the standard US GAAP cost model. Net book value or carrying value is historical cost minus accumulated depreciation. On the CPA exam, a major trap is the US GAAP revaluation model restriction. Unlike IFRS, US GAAP strictly prohibits writing PP&E up to fair value. Once capitalized, your asset value is locked at historical cost, reduced only by depreciation or permanent impairment. Understanding how transactions affect this carrying value is vital for your balance sheet prep. Let's break down how to calculate these values step by step. Every net book value calculation begins with historical cost. We capitalize all reasonable and necessary costs to get the asset ready for its intended use. This includes the purchase price, shipping, and installation. However, employee training and routine maintenance are expensed immediately. For real property transactions, remember this crucial distinction. Permanent landscaping, like grading and clearing, has an indefinite life and is capitalized directly to land. Conversely, limited life landscaping, such as shrubs or trees, is classified as a depreciable land improvement. Getting this initial classification wrong will distort your entire depreciation schedule. Why do some real property assets depreciate while others do not? It comes down to useful life. Land has an unlimited useful life, so it is never depreciated. However, land improvements like fences, parking lots, and limited life plantings wear out over time. These must be systematically depreciated over their estimated useful lives. Examiners love to test this boundary. If a transaction involves permanent site preparation, it belongs in the non-depreciable land account. If it has a limited life, capitalize it as a land improvement and reduce its value over time. Let's look at the net book value formula and the revaluation trap. Net book value equals historical cost minus accumulated depreciation. Under US GAAP, you are locked into this cost model. The revaluation model is strictly prohibited. If an asset's market value rises, you cannot write it up. If the asset is impaired, you must write it down to fair value, and US GAAP strictly prohibits any subsequent write-backs if the value recovers. Always base your balance sheet carrying value on the cost model, ignoring any market fluctuations or unauthorized revaluations. When dealing with group assets, you will encounter composite depreciation. A major examiner trap here is confusing composite life with simple average life. If you see an answer choice that simply averages the useful lives of 3 different assets, ignore it. The correction rule is strict. You must calculate composite life by dividing the total depreciable cost of all assets in the group by their total annual depreciation. Never use a simple mathematical average. This ensures the weighted average useful life accurately reflects the dollar-weighted composition of the entire asset group. Let's apply this to a work transaction. A company purchases equipment for $20,000, pays $1,000 for shipping, and $500 for installation. The total capitalized historical cost is $21,500. With a $1,500 salvage value and a 5-year useful life, the annual straight-line depreciation is $4,000. After 3 years, accumulated depreciation is $12,000, leaving a net book value of $9,500. For more practice simulations on asset transactions, head over to cpapass.ai.